Definition of financing institution. A financing institution is a business entity that specializes in carrying out funding activities, both in the form of providing funds and capital goods. In this context, financial institutions do not raise funds directly from the public as banks do, but usually get their funds from bank loans, debt securities issuance, or other sources. According to Presidential Regulation No. 9 of 2009, a financing institution is defined as a business entity that carries out financing activities in the form of the provision of funds or capital goods. Functions of financing institutions. Financing institutions have several main functions, including providing access to financing, helping individuals and businesses get funding for a variety of needs, from consumption to investment. Supporting economic growth, facilitating the flow of funds and investments that support business expansion and innovation. Improving community welfare, providing easier access to loans and protection from high-interest loans. Infrastructure development provides funding for infrastructure projects that require large investments. Types of financing institutions. In Indonesia, there are several types of financing institutions that are commonly known. Consumer Finance Company provides loans for the consumption of goods and services. Leasing providing access to consumers to use capital goods without having to buy them directly. Factoring, buying a company's trade receivables to get liquidity faster. Venture capital firm provides funding to startups or small businesses in exchange for stock ownership. Difference between financing institution and financial institution. Although often understood similarly, financial institutions and financial institutions have fundamental differences. Source of funds. Financial institutions, such as banks, collect funds from the public through savings and deposits, while financial institutions usually get funds from external sources such as bank loans. Business activities. Financing institutions focus on providing funds or capital goods without raising funds from the community directly. On the other hand, financial institutions also raise funds and have more financial products. Regulation. The regulations that govern financial institutions are different from the regulations that apply to banks. This includes provisions regarding operations and supervision. Loan collection. Challenging collection process. During the COVID-19 pandemic, finance companies experienced difficulties in collecting loans. This has led to an increase in non-performing finance, NPF, and necessitates careful loan restructuring to maintain the company's financial stability. 4. Global recession and inflation. External challenges. The multi-finance industry is also faced with external challenges such as the global recession, inflation, and rising fuel prices. This can weaken people's purchasing power and make it difficult for financing companies to access funding. Digital transformation. Internal challenges. In addition to external challenges, finance companies also have to face accelerating digital transformation. Adaptation strategies such as the development of digital platforms and integration with other financial institutions are needed to stay competitive and improve operational efficiency. The role of financial institutions in the economy. 1. Providing alternative sources of financing. 2. Supports consumption and productivity. 3. Accelerating the growth of MSMEs. 4. Increase financial inclusion. 5. Diversification of funding sources for companies. Advantages of financing institutions. Ease of access. The process of applying for financing is often easier and faster than banking. Financing flexibility. Financing institutions can offer more flexible products, both in terms of tenor, type of collateral, and interest rates. Digital innovation. The presence of fintech lending offers easy access to financial services with a fast and efficient digital process. Disadvantages of financing institutions. Higher interest rates. Interest rates of financing institutions, especially fintech lending, tend to be higher compared to traditional bank loans. Risk of default. Some services, especially in the fintech sector, have a higher risk of default, especially if there is no strong collateral. Product limitations. Not all financial institutions offer a wide range of products such as banking, especially for investment or savings needs. Conclusion. Financial institutions play a key role in the economy by providing a variety of financing services, both for consumption needs and business productivity. They help facilitate access to capital and credit for individuals and companies, especially for those who cannot access traditional banking services. The types of financing institutions available in Indonesia, including consumer finance companies, leasing, factoring, and fintech lending, provide diverse solutions to meet the financial needs of people and businesses. However, it is important for prospective customers to understand the risks and costs associated with each type of financing before making a decision.